Hi, welcome. We are really excited to be giving this presentation to you today. We've partnered with Jay-Z from Clarifi, and we have some really good information coming to you. This is Rochelle, Scout and Development Director at the NBDA, and we are going to be talking with, like I said, Jay-Z. So I'm just going to throw it over to you to introduce yourself and your company and kind of what you're going to be talking about today. Thank you for being here with us.
Absolutely. Thanks for having me. Yeah, so I am Jay-Z, the original, born at a very young age, much like most of you, I think, out there. Back in September, I started a company called Clarifi. We are a fintech company specializing in beyond the bank financing. Reached out to the NBDA probably around the same time because I'm an avid cyclist. I've been doing it for about 23 years, have the repaired collarbone, life flight bill, and all the other bumps and bruises to show my enthusiasm for the sport. Also trying to get my kids into it. My wife's pretty good as well. Clarifi was started to help bridge the gap in banking and bank financing and open up the world to beyond the bank. So I spent about 17 years in commercial banking and then another 4 years in alternative finance, and learned a lot over those years. Especially nowadays, we're finding that more and more banks or more and more small businesses are being left behind by the banks. And that comes for a lot of reasons, mainly bank efficiency and how banks operate. So banks are very people heavy, which is great, but it's not geared so much for smaller transactions. And as banks define smaller, that is usually requests below $1 million in funding need. And that could be any industry, any credit strength, any credit profile. They just don't have the resources that they used to have. Gone are the days of community banking where the community banks could really meet the needs of small business. So that is why Clarifi exists. That's why I've partnered with NBDA. And today we're going to talk about what beyond the bank financing is and educate you guys around it. And we also can help you find any funding that you need if you're growing your business. If you are looking for inventory, I know there's inventory crunches around the world. And more companies, especially bike shops, are needing to buy in bulk, where in the past they may have been able to buy as they need. And so we'll talk through some of those scenarios. But first, let's start off with why businesses exist. So a lot of businesses out there are what I call accidental businesses. So people were very good at something. All of you guys are hopefully enthusiasts about cycling and decided you wanted to provide that to your local communities. But you didn't really set out necessarily to run a business or do all the things that you need to do to optimize that business. So hopefully you guys are working with consultants and trusted partners and people to help supplement some of the business side of stuff, because that is the boring side of stuff, but it's very necessary. So businesses exist really to create value. Lots of different types of value out there. You got the value of hiring people and giving them jobs, giving people incomes. You've got the value of providing products and services to your community and to the people you serve. But today we're going to talk about another type of value, which is monetary value. So if you're running a business, the goal is to grow that business, grow that value, and then maybe someday pass that on to your kids, another generation, a friend, a partner, or even sell that business. So part of what I've done most of my career is work with businesses that are growing and want to transition, i.e. they want to sell it, they want to go do something else, or they want to monetize that value and invest it in something else. So investors value businesses based on a criteria of things. Typically, most businesses are evaluated off of the cash flow or the income. So what can an investor buy the business for and get what kind of cash flow do they get out of that? Now, each investor is going to have different optimizations. So income isn't necessarily the only measurement for the value of the business, because as you guys are owner operators, you are paying yourself. So that actually comes out where an outside investor might buy a business and not need that income. So that's actually cash flow that they can utilize somewhere else. So I did some research. I have been financing and working with bike shops for probably about 17 years now. But I did some updated research. What I found was bike shops typically trade or sell for about 2 to 2.25 their income or cash flow. So keeping that in mind will help us understand the scenario we're going to go through next, which is how do you fund your growth? How do you grow that value? And how do you, and what does all that mean? And once you inject that capital, once you grow that value, what does that mean? So growth does require capital, payroll, marketing, websites. Websites are a big one. A lot of people are going to websites now. I was talking to a local shop here that I work with, and they custom built 2 of my bikes for me. And I'm like, you guys aren't putting these bikes on your website. Like if I'm looking for a bike, you guys' builds are awesome. I get stopped frequently on my rides and people want to, look over the bike. So think about things like your website, how you're marketing yourself, how you're attracting new clients, inventory, equipment, buildings, computers, so on and so forth. All right, so funding a business. There are really only 2 ways to fund a business. That is debt or equity. So equity is an investment of capital where a business does not have a repayment schedule typically, but gives up a value in exchange for that investment. So that is, if somebody injects money into your business, they typically want some kind of return. Now they could do it as debt equity, but typically what they're saying is, hey, here's $100,000. I want X% of your business. And in return, they're getting paid through the cash flow of the business forever until you buy them out or until you sell the business altogether. Debt is the other type of funding. So that is where you get a piece of a capital, typically without giving up any equity, and you have a repayment over a period of time. Okay, so funding a business with equity. As I mentioned, there are the 2 types, or actually, there are 2 types of injection. So the equity injection where you give up a percentage of your business, but also anytime you're injecting your own capital, even without giving up more ownership in your business, that's actually an equity injection. So an equity injection from an outside investor, as I said, you're giving up a piece of that value, and remember, it's forever. So a lot of people relate to the Shark Tank scenario where you watch Shark Tank, they're like, I'll give you X amount for $100,000. I want 30% of the business. So what they're doing there is they're doing that valuation back of the math and saying, okay, your business is worth X to me, and I'll give you 100,000 because that equates to 30,000 or 30% of your business. The other type of injection is pulling that money, your own money, out of somewhere. So anytime you inject your own cash, you have other options with that cash. So there is not just the example that we're going to talk about where you pull maybe from an IRA or some kind of investment account where there may be penalties and taxes and all that, but also there's what's called opportunity cost. So if you could borrow $100,000 and put it in your business instead of having or using your $100,000, and you could invest that $100,000 somewhere else, you can spread out your investment potential or your risk, all those types of things. So just because you have your own cash, even if you're not pulling it out of an existing investment, does not mean there's not a cost to that. And in each of the scenarios with equity, you're paying taxes. So if you take on an equity investor, you make money, drops down to bottom line, you're paying the government, local taxes, all those taxes throughout that scenario. And then if you're pulling it out of an IRA, which we'll talk about in a second, you're paying taxes as well. Now, debt, on the other hand, almost every time is less expensive for a growing business, I should say, is less expensive than equity. So what debt is, again, is a tax savings. It's investing someone else's capital and with the only promise of a repayment. Usually, almost always, it should be with some kind of cost. So it's called cost or interest or whatever you want to call it, but there's a return on their investment that they're requiring. So you retain your equity position when you use debt. You have a tax savings. It helps create value in the business by funding that growth, job creation, and other benefits from that. It's also low environmental impact. That one I'm still researching, but I'm pretty sure it has a lower environmental impact. Debt also comes in several different types of structures. So one thing we do at Clarifi is we have an advice-driven approach. So when we're helping a client get capital, we really want to understand what they're putting that money towards, how they're going to repay that, how it's going to help their business grow. And if it doesn't help your business grow in a certain way or a certain rate of return for you, and how you can turn that capital, then you might not want to take on capital at all. So that's part of what we talk about. But let's say the scenario works out where, yes, this will help my business grow. This will help me accomplish some kind of goal to drive value for my business. Then we want to understand what type of structure works best for what you're trying to accomplish. Don't want to take on long-term debt for a short-term need. Don't want to take on too much too fast that you can't put to work. And don't want to leverage assets if you don't have to, houses, homes, AR, and other things. So if you can do unsecured, maybe that's a better structure. We'll talk a little bit more about structures at the end, but just keep in mind that debt isn't always just one type of structure or one type of facility. All right, I'm a big example person. So what I want to do is actually use a real life or real fake life scenario, but this is an actual scenario using numbers to help kind of drive home the point and understanding of debt versus equity. So in this example, we've got a shop that is currently doing $1.2 million in revenue, because I like round numbers and my math is a lot easier that way. So in this scenario, they're doing $1.2 million in revenue. Based on the margins that I've kind of researched, we'll call it 240, about 20% bottom line income cash flow. And that equates, based on our math at the beginning, 2 to 2.5 or 2.25 times that income would be a 480 value. So that's current state. So this shop has the opportunity to grow, and they need $100,000 to do that. So with that $100,000 investment, they could produce $120,000 in additional revenue throughout the year. That's about $10,000 a month that they would estimate they'd grow. So at the end of the year, they would be at $1,320,000. That would be $264,000 in income and a new valuation of $528,000. Now, using what we're talking about with the debt versus equity versus your personal cash, now we can run the numbers. So let's say they borrowed it and the cost was $28,000. So in the debt scenario, they would borrow $100,000 and repay $128,000 over a course of a year. Now, one unique thing about non-bank financing is most of the structures come with a prepayment savings versus a prepayment penalty. So when I was in banking, we typically had to charge a prepayment penalty. What that meant was if somebody borrowed that 100 and they just hit a home run and they grew a lot faster and like, I can pay this off, the bank would typically charge a penalty for doing that. And the reason is that they have such low return. Banks really want to make money off of your accounts, your credit cards, your personal. That's why they cross-sell you across the board. They make their money elsewhere and not necessarily that one individual loan. They also don't take risk at all. They don't like growing businesses. They like steady eddies. That really, what I would always say is, if you don't need money, the bank will give it to you. If you need it, they typically won't. So in these types of structures, there's almost always a prepayment saving. So this is if you held it throughout the entire year. Let's say it cost you $28,000 cost to get that $100,000. Now, in an outside equity scenario, you take on $100,000. If your business is currently valued at $480, for that injection, the back of the math says they're going to take 21% of the ownership, which if you grew that to $264,000 in income, you owe that investor $55,440, not just that year, but every year going forward. So that's where the outside investment is not only dilutive to your in-year income, but at the end of the day, when you sell that business, you also have to give them 21% of that sell. So a lot to think about when you take on an outside investor. I speak from experience. I have taken on outside investors. I've given up equity, and it hurts a little. So usually you want to avoid that scenario if at all possible. Now, in the other scenario, I got this a lot in banking as well. It's like, well, I've got, a retirement account or investment account or this or that. I can just use my own money. Correct? You could, no problem. But if any of you have ever drawn out of any investment account, especially if it has any type of retirement component, the IRS, God bless them, also penalizes you for taking that out early. Unless you're, I think it's 65 or something, then you don't get that penalty, but you still have to pay taxes. And then there's still the loss of annualized return. So if you take 100,000 out of an IRA, you're going to get penalized 10, taxes probably around 15 on that. And then you're losing 12,000 potential over this year scenario that we're going through in return on that investment. So you add all that up, that's 37,000. So at the end of the day, still debt, even at a higher cost of debt, is less expensive than giving up equity. All right, and so continuing the example, now we're at a million 320 revenue, 264 income, 528 new business value. And so for $100,000 that only cost you 28,000, you were able to drive 24,000 more of additional income, 48,000 in additional value, and 120,000 in revenue growth. So remember, the more revenue you can drive, the longer term value you have. So as long as your revenue is driving up, that's a good thing, even if your income isn't driving up or your cash flow isn't driving up at the same margin. And I say that because an investor could come in and say, okay, with 5 million in revenue, I can make these efficiencies, thus drive more value in the business, even though you might not have those efficiencies as the operator. So it is important to continue to drive revenue. It is important to also drive good net margins, but at the end of the day, all of those things drive your business value. All right. Another thing I want to go over is just a reminder that this is business lending, not personal lending. And I'm not saying that to say that you'd come to Clarifi for personal lending, but one thing I want you to think about is over the years, I constantly got told, well, okay, but my grandma, my dad, my mom, my life counselor or what have you tells me borrowing is bad. And on the personal side, the Dave Ramseys of the world, are going to agree with that, right? Now, I disagree to some extent with the cost of houses and cars. So maybe those are two things that you borrow for. But typically on personal, you're borrowing just to get something before you could save up for it, or to stretch out payments, or for some other reason, not driving more income. So personally, if you borrowed $100,000 and let's say you were just a W-2 employee making, $50,000, you borrow 100, it's not going to make you make 250 or 100,000 or what have you. So debt on the personal side, correct, maybe not always the best decision. But on business side, back to the example, could be a less costly way, a way to spread out your risk to fund your business. But ultimately, whether you take on equity or you take on debt, the goal is you can create more value, you can create more income. So you are getting what's called a return on investment. Personal, not really a return on investment. If you're taking personal money and investing in like a rental home or something like that, it's actually a business, not a personal need. So same scenario still holds: business debt, return on investment; personal, not so much. Personal also is typically tied to some kind of asset. Now they are doing a lot more unsecured personal stuff, but then you become even more risky also from your personal standpoint, because it is, if you run into hard times, there's not really an asset that you could sell to kind of pay that off, or to lower that debt cost or that debt that you have outstanding. But with business borrowing, it's typically always running a return. And back to my previous statement, where If it's not going to get that return, then that's where we probably counsel you to not take on the debt. But if we can look at the business, you can look at the business, you say, if I get this, I can do this. Now there's always the risk that it doesn't pan out, right? But you want to be putting that towards another location, inventory that you can turn quickly, hiring that mechanic that has a much larger return on their time than selling that inventory, getting those supplies you need, marketing your company, things like that, that'll drive that good return. Also, personal lending or personal debt is typically way less expensive. Back to my previous point that it's tied to a quote unquote, steady income, being at a W-2 or a long time self-employed, and also an asset, to where business borrowing has that risk of, okay, I'm giving you the money to grow your business. We're taking a risk that you don't do that. And you're taking a risk that you don't do that, but hopefully at the end of the day, that risk pans out for everybody. All right, let's talk about structures. So outside of bank, your bank financing, there are at any given time probably 4,000 to 5,000 different individual lenders out there. Part of what we do at Clarifi, we work with a little over 300 lenders. We have technology and resources to help us understand credit boxes and what's the right fit and all that. So we're very optimized on the back end to figure out which lenders are going to solve which problems. But there are thousands and thousands of lenders out there. Some of them are terrible bad players. Some of them will put clients in bad places and bad, just bad in general. Like there's a lot of shady characters outside the bank because a lot of that lending is unregulated. It's usually a private fund that is funding it. So it takes some professionals in that chain to make sure we're matching the right client with the right lender. But what we do at Clarifi is we also hire and fire lenders. Like if we find out a lender is not doing the right things or they're financially unstable, because if a lender goes out of business, it could hurt the client, even though you owe them money. And any of you who lived through the economic downturn in the early 2000s know exactly what I mean. When your line gets frozen or when your bank goes out of business, it can hurt your operations as well. So we do a lot of vetting of the lenders. We have a very smooth process for the clients. You just go to the NBDA link, click that, takes you right to the Clarifi application. Takes about 10 minutes to fill out. We do pull in data, including a soft credit pool. Personal credit does come into play for business lending. It's not the only determinant, but it is one of the keys. Some of the structures that we'll talk about have what's called recourse. That's a personal guarantee. So if the business fails to fulfill their debt requirement, the lender will go after the business. And then if they can't recoup what they need, then the person backing it is on the line. Then there are some that are called non-recourse, which means there is no personal guarantee. Those are typically larger businesses. Those are typically well-secured facilities, things like that. So for the most part, most of them have some kind of recourse on the individual running the business. Because again, we are small businesses and we are the business in a lot of cases. So we do need to back that up. So all that data comes in, you upload 3 months of bank statements and a picture ID. And it takes us about, 15 minutes to an hour to kind of analyze everything, put everything together, figure out what lenders could solve the problem. We have a follow-up conversation with you to make sure we're all on the same page, what you're trying to accomplish. And then within a few days, you could be funded in the funding that you need. So lines of credit can move really quick. Unsecured term loans move very, very quick. And then secured term loans typically take a little bit longer. If it's a building backed loan, then it's going to have some due diligence around the building. If it's equipment, those typically actually move pretty quick, but there's still some due diligence around the asset underlining it. And then a structure that you guys might not be familiar with is what I call a revenue advance. So we're going to start in the upper left-hand corner with revenue advance. What that is, you might have heard the term merchant cash advance. Those were back in the day where everybody was running credit card and a lender would come in and do a split. Well, part of that is you don't really understand the cost of what you're doing. So we don't really do much of those where it's a split off of that. We do more of the bank style revenue advance where you clearly know what you're borrowing, how much you're repaying, and what that requires. But the interesting thing about those structures is they're not a fixed term loan. So most, depending on where you guys are located, a lot of bike shops are pretty seasonal, right? Some of you may sell, ski supplies and other supplies where you kind of offset some of that seasonality. But often a lot of businesses have some kind of down month or down couple months, and then some months where they spike a lot. The nice thing about advancing off your revenue, what they're doing is buying your future revenue potential and funding against that, is it ebbs and flows with your seasonality. So it's not as, it may cost the same at the end of the day as any other of these other facilities, but what happens is the payments ebb and flow. So as you make a lot of money, that you pay them back a little bit quicker, and then when things slow down, you pay them back a little slower. But what they're doing is setting up the facility over a period of time where those ebbs and flows are going to meet the repayment. So interesting structure, very good for newer businesses. I mean, we can go down to as early as 6 months in those scenarios, as long as there's some revenue flowing. And what that really does is help you ramp up and get a little bit of capital injected to then ramp up. And then maybe you graduate to a more structured type facility. So the second type is the unsecured term loan. So most of you probably familiar with these, fully amortizing, borrow 100,000, you're paying in that scenario 128,000. You divide that by, most of them do a weekly payment, so you divide it by the 52 weeks, and that is your payment. And it just stays the same across the board. And you pay that back again if you hold it the entire time, or you get an influx of cash and you want to pay it off, you can do that as well. Those ones usually need a little bit more time in business, but 2 years in business is still very young for even business lending, or sorry, bank lending. So not a bad structure. I like that structure a lot just because there's a known payment. It's a familiar type of structure, and it helps the client really understand what they need or what they're going to be repaying and how they're going to do it. The next one is the line of credit. This is where you get approved for a certain amount, you borrow on it, you pay it back, you borrow on it, you pay it back. Usually stay in place for, however long you want it. Some of them get re-looked at every year or so just to make sure everything's still good. Also, as you grow, you may want to have it re-looked at to increase that amount. But those revolve, but not like a bank line of credit. They're typically, what you do is you draw on it, and that draw is then termed out or amortized over a certain period. 6 months, 12 months are usually the limits on those, which is a really nice structure. Because one thing I found in banking was businesses would get lines of credit, and then they would either never borrow on it, which means they didn't need it, which is bad for the bank or anybody lending it, because what they have to do is set aside that capital that they can never make a return on. So banks are hesitant to give the line of credit. But then the other scenario I saw a lot was they would get a line of credit, maybe it's $100,000, and never revolve it. And if you're never revolving it, that typically tells anybody who's doing the structure that you actually needed some kind of term loan. So these lines of credit are really useful for the borrower, and also help you guys pay it back and know that you're paying it back with the amortization schedule there. And again, same kind of thing. If you pay it off early, or you don't carry it all the way through the amortization period, you save whatever future interest you would have paid on that had you taken it to term. So we can do some structures for startups, usually about 6 months in business for the unsecured. Startup ones are usually backed by some kind of business receivable, so probably not as applicable to retail where you're selling to a consumer. And then the last one is secured term loan. So that's a catch-all for anything that you're securing. So that could be equipment. We do a lot of equipment financing. It could actually even be secured against what you might not consider an asset. So these days, like if you bought a marketing technology or you bought data or something like that, and you have any type of like contract, they can actually secure against that. So sometimes secured isn't necessarily something you can touch or think about as secured, but at the end of the day, some kind of asset, some kind of valued something that a lender sees is backing it up. So your traditional ones are the equipment and buildings, vehicles in that scenario. Most of our lenders, we actually do have some that'll do startup secured term loans, but most of them you're getting a better structure and more likelihood of getting approved around the two years in business and above. And then personal credit scores, we can actually go down to around 550. Most of what we're seeing is in the 600 to 700 range. That credit score, like I said earlier, isn't necessarily a do or die for the, whether they would do the funding or not, but it definitely is going to help with the pricing. So the better that is, the better the time in business, the better, all those due diligence pieces that are going to be checked out, the lower the cost that can be provided. Because again, they're matching costs with risk and what's being accomplished. And anything under 100,000, the 3 months bank statements and the ID is typically that's all it's needed. Now, in some of the 100 plus, they may ask for just 1 year business tax return. They may ask for a few more bank statements, especially if you have seasonality. But at the end of the day, these deals are very easy on you trying to run your business, not go and dig up years worth of documents like a bank's going to need and sit around and wait months to even know if something can be solved for. So we not only act quickly, but our lenders that we support also act quickly, and we can get deals done in days and not weeks or months. So that is all I have as far as presentation. So I see, what do we have? One question, Rochelle?
One so far. It's more of a comment on the 20% bottom line.
Hey, I said that was just that was also not taking out owner comp. So there.
So if anyone has questions, feel free to put them in the chat. JZ, would you mind giving your contact info in case people who are watching the recording have questions for you?
Yeah, absolutely. And we can follow up, I guess, with the email blast too, but it's JZ, just the letter J, letter Z, or you want me to write it in the chat? Would that be better? Clarifi Born. And then 804 651. And then our website is just clarifylending.com. But again, there's a link directly to everything on the NBDA site. Gives a little bit of overview of some of the stuff I've talked about. I guess this presentation will also be available, the recording and all that. But happy to answer questions. I already have a few members who've reached out, I guess, when we did our official announcement that we partnered. So with those ones, I just kind of gave some knowledge, and we went back and forth, and we're trying to figure out what they're trying to solve for. Sometimes we are the solution, sometimes our lenders are, and sometimes I just give you some advice to go take and figure out maybe a solution that would work for you.
We do have a question. If you have your personal capital to fund a project, is there ever any reason not to use your own capital?
Personally, so just so you know, I mean, we started Clarifi in September of last year, right? So this is a small business as well, and I've injected some. I've got outside investors that have injected some. I did not inject any of my own because I wanted to diversify my risk, right? As a startup and all that stuff, you want to kind of have your rainy day fund, your other capital. So at the end of the day, my philosophy is if you can again, you're going to have to answer to them, whether it be interest payment, return on their investment. But if you can leverage someone else's money and drive value that eventually gives you more value, then I like that scenario. Is there a time where you wouldn't want to do your own? Kind of back to that, what else could you do with it? So let's say you had we're going to stick with the same scenario. You have $100,000 and you have $100,000 need in your business, and it's just cash sitting in your savings account. I would say, personally, borrow the money because it's a tax write-off, for the business. So that 28,000 cost that we were talking about, that's a write-off. So that's before taxes. So if you saved 15% in taxes, your overall cost of that capital goes down. So when you take taxes into the scenario, that actually is a wise way to invest in the business because you've got a tax savings. If you take that same $100,000 of capital of your own, put it into the business, you're not getting any tax savings, right? And let's say that 100,000 drove the, what do we say, $48,000 in additional income. Now you're paying taxes on that 48,000, right? So I'm sure all of you don't find or I should say, I hope all of you find every way to write off everything so you're not paying a bunch of taxes at the end of the day, right? That's why you run as much through the business as possible to drive down the income. So that 20%, sorry, I forgot the name since it fell off, but that 20% bottom line was actually cash flow, not necessarily income. So if you can find ways to reduce that income, then you're not, most of you are probably structured in some kind of way where you pay, personal taxes on whatever income that you get from the business. So if you inject that personal capital, drops to the bottom line, you're paying taxes on it. So I would rather take that 100,000, put it into, even if it's an IRA where I can't touch it, something that has some kind of return. And from my years in finance, I've seen, which have been 20 plus, I've seen that you're typically going to get a 10 to 12% return over time in some kind of stock, portfolio or some kind of IRA that's backed by stocks and things like that. So you could earn 12% a year on that money, or you could inject it and pay taxes on it. If I borrow, I've got 200,000 to play with now. So I borrowed 100 to run my business because that's what I need. Now I've got 100. I can go invest somewhere else, and put it away for a rainy day and get a return on it. So yeah, I would say there's lots of reasons why I would not inject my own capital if I could borrow. And again, borrow reasonably, right? There's the extreme in every scenario. There's the extreme where you what's called over leverage and put your business out of business. So in the conversation I was having with the early on person who reached out when we joined the NBDA, his comment back was, hey, I can't, the money was going towards buying a building, right, which doesn't have as fast a return. So we were talking about, maybe borrowing short term to inject in that building. He's like, my shop's not going to produce enough quick enough to repay that. I'm like, yeah, you're right. So we ran through the scenarios. Now we're going to go back and maybe look at a line of credit to where he can kind of take it as he needs it rather than the term loan where he gets in a lump sum. So as long as you have the right structure, I would almost always inject somebody else's money, hopefully debt, because then you're giving up less, and have 200,000 to play with rather than just the 100 that I now have to move over here. Conversely, we were talking in our kind of pre-call with Rochelle, was anytime you take money out of a business, you have to replace it with something. So case in point, if you look at your profit and loss, you've got money, you got revenue that comes in, you got your expenses, and you've got your profit, right? Now you carry that over to your balance sheet. If you had a profit, that goes into your balance sheet. And a balance sheet should, and please all call your Congress people to remind them, a balance sheet should balance. That's why it's called a balance sheet. So assets equal liability and equity. So those are the two ways you fund a business: assets, which or equity or liability. So equity and liabilities fund those assets. So that profit comes over. If that profit wasn't taken out of the business and it sits in cash, which sits up in the equity, or sorry, in the asset, and then if you didn't borrow or anything, then it plugs into your equity position. So now you've got $100,000 that you produced out of the business. It's sitting in cash, right? And equity. So that balances it out. So it's equity and you've got cash. Now you're like, oh, I need $100,000, because my family's going on vacation, or we're buying this house, or something personal that you got to take it out for any reason. It could be another business. Whatever reason you're taking that money out of your business, you got to replace it with something, because it's going to come out as cash and the equity is going to be reduced. And if you're going to continue to run your business at any level, it's got to be replaced with something. So in a debt scenario, you would take it out of equity, you would put it into liability, and then the cash would still be there. So those are just some things to think about. Your personal cash is not free, and by the way, is rapidly deflating if you're not investing it in something else. So you want to keep those investments diverse. You've got a business to run, which is already risky, so spread out that risk and do it wisely. It would be my thought on that.
Perfect. And then we have a comment here, which I'm sure this person is not alone in saying that I've been running my shop for 16 years and still feel lost in all of it.
Yeah, and like lost in this understanding, or lost in how to run it, or what? Lost in a lot of ways.
Yeah, understanding all the various types of funding, I imagine.
Yeah, and that's why even in my banking days, I call what I said, I always differentiated in an undifferentiated world. So lost in how the industry was changed. That, yeah. So wise counsel, support, outside advisors is kind of what I was getting at with what I was talking about. That's why we're here, because yes, a lot has changed. You used to be able to, like I said at the beginning, you probably used to be able to buy, five units of something, sell that over a few weeks, buy 5 more units. I know even 15, 20 years ago, maybe it's changed a little bit now. I've written a few business plans on bike shops, but it's been a while. It was during business school that I was doing that. But back then, what I realized was your giants, your specialized, your Treks, your big companies who supply now not just the bikes, but seems like all the parts. Don't want to extend terms to you. Don't want to do any of that if you're a smaller shop. So you had to borrow to buy in bulk, or you had to figure out how to manage your cash flow. So yeah, how to manage your cash flow. Inventory is both the life and death of a business. And yeah, absolutely shrinking margins. So inventory itself, if you're not turning it fast enough, will kill your business. But in your case where you're selling a product, if you don't have it, you also can't grow your business. So it is a double-edged sword where you want to get it and turn it fast enough. Now, from what I'm hearing in the market is that you're even ones who were able to get terms or whatever, since there's such low inventory and shrinking margins and all that, the manufacturers and suppliers are pushing the risk onto the business, right? It's like you need to fund it, you need to get it. So that's where things like maybe a line of credit, maybe an unsecured facility can help spread out that cost, spread out that time. But really, and again, I'm dangerous, but I'm by no means giving you exact advice. But one thing that I tell my local shops, because I love helping them, I like I said with the scenario, like put these bikes on, advertise yourself. Nobody knows what you guys all do. Like, don't rely just on me. Like, word of mouth is definitely your best, absolutely hands down best marketing. Because I'll tell you what, I've sold more bikes and made no money on it because they find out I'm passionate, and I vet, where I send them, and I help them understand what they need to get, whether it be mountain bike or dirt jumper or cross country or what have you. And I talk them to death about all the different types of bikes out there. But from a business perspective, remember, service, you guys are more and more running into just like a car dealer. A car dealer makes little, if nothing, sometimes takes a loss on the actual cars, right? What they want to do is drive, well, they were doing okay on the used, but on new cars, they wanted to drive you to the service. So just remember, like, your your service is huge these days, especially what I've seen. I advertise and advocate for particularly mountain biking. We had too many deaths where we were in road biking. So I've strictly gone to mountain biking, but I advocated for this sport for 23 years. And I think I did a little bit too good a job. Now all the trails are slammed every time I go, but that's also great. People are getting into the sport. But I think, kind of helping them understand, hey, you need to keep this thing tuned up. You're bombing down the hill. You want to make sure it's in good working order, all of those different things. So really think about the other things that push you making money, where you might not even need inventory as in the full bike. You might need the supplies and such. But so your shop, what you do in your shop, what you do in your repairs and things like that. Think about that. Think about driving up that return rather than just selling the units is some transition that you're going to have to make. And they, I just saw, I think it was NBDA who was putting out, I guess you guys were talking about like kiosks and things like that, like maybe shrinking the size of the footprint, because rent is obviously, or even if you own it, like size matters, locations. Just keep in mind, people don't drive so far. They want it kind of convenient. So you could also expand your revenue by getting additional locations, even if it's, take this one, cut it in half, get another one somewhere else. But I really harp on the service side. Like I spend way too much in service. I can do a lot of the mechanic stuff myself, but at the end of the day, there's a lot I don't want to do. And I'm also busy. So I love taking it to the shop, doing my 2 or 3 times a year tune-ups and just making sure everything's in good working order. So market yourself, talk about yourself, get yourself out there and aware. I think online presence is going to be really, really big. Also, there's some good, marketing and data. Data is a big thing now. Like, how do you get to the end client, that type of stuff. I will give you one scenario and then I don't know how much more time we have, but one scenario I had back in the day, great shop, had really good margins, was looking to buy a building, and they had the injection, they had all that. But the way banks underwrite, which I didn't talk about, banks underwrite on what's usually an EBITDA or a debt service. So how much income, sometimes globally, your personal and your business, and then what's the debt service, and then how much multiple of that can they lend on. Most of this beyond the bank lending does more cash flow based lending, meaning how much revenue are you driving in, and then they lend off of that. Well, in the bank world, he was like razor thin at the bottom, and I went through his P&L and I went through his balance sheet, and I'm just like, what is going on? Like, you have such good margins. Where's this all going? Then I went to his marketing budget. I'm like, why are you spending $120,000 a year on this line item that just says team? He's like, well, I'm sponsoring a team. I'm like, for $120,000 a year? I'm like, what kind of return are you getting? Because everybody in the country knew this shop. I mean, he was selling online before other people even knew online existed. And so everybody knew the shop. I'm like, you didn't need to advertise yourself in that way. And he's like, oh yeah. I was like, you're not getting no return if you spend 120,000. So unfortunately, that team wasn't sponsored anymore, but he had 120,000 he could drop to the bottom line now, instead of tying it up in something that didn't make sense. So I'll just say, go through your business, understand that it's an online world. How can you capitalize on that? Can you sell parts? Can you sell, yourself being, hey, we build bikes or we build wheels, something around the service aspect where you can charge a higher margin than a, X markup on a bicycle itself. So those are some things to think about there.
Thank you so much for sharing with us all of your knowledge. We really, really appreciate it. And then, like I said, if anyone has questions afterward, or if anyone is watching the recording and has questions, please reach out to us, info@nbda.com, and we'll pass it on. Or it was jz@clarifylending.com. Is that right?
Yep.
Perfect.
And this does say mountain bikes, not Mountain Dew.
Thank you again for being here. We're going to wrap
Thanks
it
for
up
having me
here and let people get back to their business. So I'll say have a great weekend, everyone, and thanks again.
Thank you.